Hi, Jim Yent from Golden Years Advisors, the home of the Kairos formula. Well, it's March 3rd, and that means it's March Madness time. College basketball at its best. I hope your team makes it into the brackets, and I hope they have a good run. But we're not talking about basketball here. We're talking about a different type of March Madness. And one of our favorite analysts, Ed Yardeni of Yardeni Research and Associates, he titled a recent forecast March Madness. And the reason being is he thinks that from a press perspective, as well as what the Fed will be going through over the next 1 to 3 months, will have a lot of madness to it and will clearly have an impact on the markets. So I'm going to jump into it. But first, I want to give you just a quick update on where we're at on some things we talked about since the kickoff meeting. During that kickoff meeting, we talked about, for instance, from a market perspective, the S&P has made numerous attempts at trying to climb above its 200-day moving average. And on the chart here, you see this blue line here, that's the S&P 500. That was our peak last year, January 3rd, 2022. It's been 15 months we've been in this bear market. And this blue line represents the 200-day moving average. And typically, when an index is beneath that 200-day moving average, it's a bad thing. And it has been for the bulk of these last 15 months. So we broke it, rallied once against it, fell, second time came through it, third time tried to approach it. And as of the kickoff meeting, we did a fourth try and said we were making a fifth attempt. Well, since then, we've remained above it, just barely, but we've spent about a month above the 200-day moving average. That's a good sign. Doesn't mean we're out of the woods, and we'll see if it holds. But that's something that we can at least hang our hat on, saying, hey, that's the best we've done in 15 months. So let's keep our eye on it. So now let's switch to Ed's forecast. What Ed tried to portray, and in the past we've used City National Rockdale's forecast, and it's not that dissimilar, but there's a little bit more gradation in this. You'll see a big blue line here down the middle. Everything to the left is what I call the optimistic view. And we have 4 scenarios here. And everything on the right is more of a pessimistic view. And Ed gave actual probabilities. So 40% to something he calls a soft landing, 20% to a disinflationary no landing. Then on the pessimistic side, 20% on a hard landing, 20% on a inflationary low no landing that eventually leads to a hard landing. What the heck does that mean? Well, what Ed tried to do and what I tried to show on this chart is the difference between each one of them. So let's kind of dive into them quickly. On the soft landing side, what he means is that the economy keeps slowing down, like we've told you, and stalls out. It just kind of flatlines with GDP somewhere around the 0 point. Maybe it's a little bit over, but it's essentially flat. From an inflation perspective, he did not use the CPI, Consumer Price Index, which many of us know and love. He used the same measurement that the Federal Reserve uses, the PCED, the Personal Consumption Expenditures Deflator. And his comment is, in this soft landing approach, GDP flatlines. Inflation does come down. I mean, it's in the 5-6 range, but by year end, he said somewhere between 3 to 4%. He said the Fed funds rate, which is currently about 4.75, will make it somewhere between 5 to 5.25, and there'll probably be a pause there. The 10-year Treasury will stall out. It'll get as high as 4.25, which it hit last year, and right now it's creeping above 4. From an S&P perspective, he said if all that happens in this scenario, what you'll see for the earnings per share coming out of the S&P is on a this year and next year number that the earnings will come in about $225 per share for this year and next year, which is up, which will be about a 5 to 10% gain from last year, high single-digit gain. And that next year will be even stronger at a $250 a share basis. And he actually went so far as actually name a number as to where the S&P will be. And he kind of gave 2 timeframes, at least on the first 2 of his scenarios. He said mid-year, in this soft landing, a flat lining of growth, but profits although they shrink for a bit in the first half, they rebound in the second half. Says the S&P makes it to about 4,500 by mid-year and then starts approaching its all-time high, which was right around 4,800 by year end. That's a soft landing, and that's an optimistic one, and it's one where he kind of has it as the most likely. Just as a comment to you, to put this in perspective, if we jump to the Federal Reserve, they forecast every 3 to 6 months something they call their summary of economic projections. They too are forecasting a soft landing. Namely, in this year, they think we flatline. They think their inflation number comes down to about 3, and then the year after 2.5, and eventually hits their target of low 2s. And from a Fed funds rate, they think they barely get above 5, kind of what the Yardeni forecast says, and then gets lower in subsequent years. So Ed's base case forecast is really what the Fed is currently saying. Now, remember, at the end of this month will be the next Fed meeting, and we'll get an update on these numbers, and that'll be very important, which is why we're showing this now. The second optimistic one they call it a disinflationary one, but they call it a no landing, meaning the economic growth doesn't even come to a flatlining. Instead, GDP actually grows a bit. We have about 2 to 3% economic growth. And the key of this scenario is the disinflationary comment. By that he means inflation continues to fall, and in particular, price inflation, what we pay at the pump, at the grocery store, everywhere else, decelerates and falls further than what the current wage inflation, because the whole concern that the Fed has is that you'll get what's called a wage price spiral that'll keep going. So price inflation falls much more than wage inflation. If that happens, that means any increases in wages are real. We'll get real growth, real income in our pockets, and the economy will keep going. Therefore, we'll have positive GDP. If that happens, he says, since the economy still grows strong, it doesn't slow down as much, the Fed will probably be scared and will raise rates even higher than their current soft landing. So he said you might see the Fed funds rate get a 1/4 point to a 1/2 point higher, 5.5 to 5.25, and therefore the 10-year Treasury climbs even higher. His comment is because it doesn't slow down the economy, the earnings of the S&P will be even better. So if his base case soft landing was a 225 and a 250, he says in this disinflationary one where we don't bottom out the economy, it'll be even better profits. Well, you would think that would mean a better market, but Ed tried to warn us, no, we're going to be range bound. We're going to be stuck. And we're going to be stuck kind of where we're at now. We're stuck around 4,000 for the S&P 500. We creep a bit above it, and we usually stall out. So we seem to bounce right now somewhere between 3,800 to as high as about 4,200. But we're stuck because as rates get higher, it doesn't matter if profits are that much higher. A higher rate means the S&P shouldn't be priced higher. It's not fair value. It'll be a more expensive value. So it's optimistic from an economy perspective, and the market's not crashing. We know that the bottom is behind us. The bear market is behind us, but it's not as favorable as rosy as this one. So those are the optimistic ones. Let's jump on the 2 pessimistic ones. This is the so-called hard landing that everyone's talked about. In the hard landing, the Fed is not trying to create a recession, but the belief is they will do one. It's an unintended recession. And so as a result, rather than merely flatlining, we'll actually see GDP go negative. And maybe for a couple of quarters, but when you add it up across the full year, maybe we're down 1 to 2% from a GDP perspective. Inflation falls because of that recession. One of the beliefs that the market has, and really the Fed has kind of acknowledged, they want to just get the rates and hold it there. But if unemployment starts spiking, they're already prepared for unemployment to rise. It's currently at near an all-time low, 3.4 to 3.5. They're willing for it to go up about a point, maybe a little bit more, maybe to 4.5, but they kind of target, we don't think we'll get to 5. But as it gets closer and closer to 5, 4.7, 4.8, there'll probably be a lot of incentive for them to start lowering their Fed funds rate, which will also lower the 10-year treasuries. So bottom line is we'll be in a recession. So we're not going to hit those targets for the profitability of the S&P 500. We won't hit the 225 this year or the 250 next year. What that really means is, we'll probably test last October's bottom. Back on that last chart right in here in October, the market fell just beneath 3,800 on the S&P 500, just a tad, about 20, 25 points beneath it. But if we hit a true recession, and everyone calls it a recession, there's probably a deeper bottom and a longer time for recovery. Here's the final case we just want to put on the table. He calls it inflationary, but there is no landing. The economy stays strong, but because it's both inflationary and the economy stays strong, the Fed gets even more aggressive. And as a result, they intend to create a recession. And we do get to a hard landing, but it's because the Fed literally is forcing a recession. It'll happen only if inflation remains persistent. Thus far, it's been trending the right way. So the next couple of months, the March CPI and PCE announcements, as well as the April announcements, will be really key. There'll be a tendency to drive the Fed funds rate and therefore the treasuries even higher. And if it's a harder recession or a forced recession, earnings will be worse and the bottom could be even deeper. People ask how deep. Well, put it this way, when we hit our October bottom, the PE, how pricey or expensive the market is, was at 15. When you have real recessions, you'll often see that PE fall to something like a 10. How deep could that be? That could be in the 3,500 or lower range for the S&P 500. So that's the scoop. We wanted to get it out to you because in the next 1 to 3 months, we'll have a different type of madness. It'll be in the press. You're going to hear the talking heads talking all about this stuff. And you'll see the Fed waiting for the data and being data dependent. They're doing a good job. They are going to win. They are going to beat inflation. But depending on which one of these 4 courses the general economy takes, as well as their action takes, it's really going to determine how the recovery and how 2023 plays out. Real quickly, from a portfolio perspective, we think we have you positioned properly for this right now. We are extending and making more use of buffers. We are extended and more in value-based things, mid-cap things that should be strong through this type of environment. If we do see one of the rightmost scenarios, these pessimistic scenarios happen and we start testing some of the lows, you'll watch us get defensive. But otherwise, we like where we are. Okay, we wanted to give you that update. If you have any questions, give us a buzz and may your team do well in March Madness.